Welcome to Crescat's live market call featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please refer to our important disclosures pages on the screen now. These can also be found in the description on Crescat's YouTube channel and on our website. Crescat's live market call is about sharing timely macro and newsworthy geologic updates, both the positive and negative news across our holdings as they arise. These videos represent the opinions of Crescat as a mining and exploration industry advocate. Our objective is to share the overall geologic progress of our activist strategy in creating new economic metal deposits in viable mining jurisdictions around the world. These securities, the securities discussed herein, do not represent an entire portfolio, and in the aggregate may only represent a small percentage of a strategy's holdings. The issuers discussed may or may not be held in Crescat's client portfolios at any given time. This video is not intended to be, nor should it be construed as, an offer to sell or a solicitation of an offer to buy any security. If you enjoy our videos, please click on the like button and make sure you're subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on Twitter for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about Crescat's investment strategies, we encourage you to reach out to Merrick Iwahashi. His contact information is on the screen now and can also be found on our website at Crescat.net. So let's get started. Again, the usual format. I'm going to start off with some brief, overview of some macro things going on. Tavi's going to get in more depth on the macro, and then Quentin will get into the mining stocks and the geologic updates. So some exciting things have been going on. This is today we got the University of Michigan surveys, once again, consumer surveys, and we had another 0.9% jump in the mean long-term inflation expectations. This is contrary to what you are hearing from the Fed, that the inflation data is slowing, that inflation is heading towards the 2% target. Inflation expectations, especially long-term inflation expectations, are not well anchored at all, and they are not, even at the median, which is that white line in this chart. They are not coming down towards the 2% target. They're still hanging up around 3%. But the mean of this University of Michigan survey is the biggest concern, because that shows the broad dispersion of inflation expectations, and it's the higher inflation expectations among the lower income classes, the ones that are hurt the most by inflation, and the one where all of their spending, none of their spending is going into savings anyway. It's all going into consumption, and this is a very bad trend for inflation, and it just keeps getting worse. It's not getting better. Let's go on to the next. So we started to see some volatility creep back into the S&P 500. We've had a significant pullback, nothing major, but off of the recent highs. Earlier this month, the S&P 500 was reaching new highs, and we've had a substantial pullback. This is a chart that Nathaniel put together, and what it's showing is the number of days since we've had a 2% or greater single down day in the S&P 500. We just had one this week, and we hadn't had one since 2007. So this is when you look at this chart, you can see how normally and over time, look at how the blue lines are much lower between the 0 and 100 days. Normally, we have much more frequent down days in the S&P 500 of 2% or more. It used to be a normal thing. back in the days, and maybe it's going to start to become a normal thing again. Certainly, volatility is increasing, but we're still coming off of very low levels for VIX. And of course, we're anticipating a recession. We're anticipating a correction a bigger correction to come in the S&P 500 off of historic valuations, especially for the Magnificent Seven. We're seeing what we've been calling the Great Rotation coming. You're hearing Bloomberg talk about the Great Rotation, and other managers now coming on and talking about the Great Rotation. We agree on what people will be rotating out of, and that's the mega cap tech stocks, most certainly. The other large cap growth stocks and overvalued large cap growth stocks in general. But it's broader than just large cap growth. The S&P 500 at large still has historic valuations in aggregate, and there's a number of other industry groups that are at risk, including consumer discretionary. But our great rotation thesis really relies on rotating out of overvalued financial assets, which includes fixed income securities. And we've been talking about this for a couple of years, and we've gotten this right. As the long end of the curve, rates have risen substantially on the long end of the curve, but it's rotating into undervalued commodities and natural resource stocks amidst supply constraints. We are starting to see glimpses of this, but the bigger rotation into commodities is only just beginning, and the deep value, high growth opportunity in the commodity stocks. This is what the real great rotation is all about. Is a rotation into commodities, and we have hardly even begun to see it yet, but we're starting to. And into commodity resource equities, where we are positioned substantially on the long side. Let's go on to my last chart. So this is looking at Google's earnings. We've been talking about the creative destruction that's likely in the mega cap tech stocks because of AI. This AI euphoria has led to an even further increase in the prices of the Magnificent Seven stocks, and in the concentration of those stocks in the S&P 500. But what is really going on with this AI revolution, this AI euphoria? It's a theme of creative destruction, where the new technology is jeopardizing these monopoly business models of these mega cap tech stocks. And so how's that happening with Google, and why hasn't this narrative even been discussed with Google? I don't know why the narrative is not being discussed, because a lot of the analysts will still come on and say Google had a great quarter, but they're not looking at free cash flow. They're not looking at the CapEx trends. Guess what? Google's free cash flow last quarter was down 40% year over year. Their CapEx increased year over year from $7 billion to $13 billion. They're having to spend like $100 billion a year, including R&D and CapEx now, to get into the AI game in a bigger way. They're trying to compete with Amazon on cloud services, with Amazon and Microsoft. It's not their traditional business model. Their profits come from search and advertising. At the same time, their search model is being threatened. Their advertising and search model is being threatened because of AI and the new search technologies that these large language models allow, that allow other competitors to be coming into the game and allow places for people to do their searching outside of Google. How's Google going to collect ad revenues if people are not searching on Google? And they're starting to move their searches to other platforms like Perplexity or even Bing. So this is creative destruction. This is competition that threatens these monopoly business models. Google's operating cash flow was down. That's not growth. It was down year over year. Their free cash flow was down 40%. How are these companies going to capitalize on this increased huge investment? This is the same problem that we had at the peak of the tech bubble, when the CapEx was just screaming up off the charts as everyone was trying to invest in fiber optic cables and Cisco routers and there was, but that was the peak of the business cycle. It was not sustainable. That's all I have for now. Let's turn it over to Tavi.
Sorry, unmuted. All right, thanks, Kevin. Well, let's get started. There's a lot to talk about. We'll be posting a research letter on Saturday is the plan. And I will be discussing a little bit of that and the thesis behind this idea of the letter in this for Saturday. So, there have been two macro developments, I would say, since 2020, since the pandemic of recession and the response from policymakers. One of them was the inflation resurgence. Now, I remember back in 2020, we were reading about the Spanish flu back in 1919 and how that response from policymakers back in those days actually caused inflation to get out of control. And then from there, we've had a view about that really started to materialize in 2021 regarding the issuances of treasuries and how that could potentially have an impact on the rise of interest rates. Those, to me, have been arguably the most important developments we've had since 2020. Then these two issues cause other things. Central banks have started to buy gold. We've had intensifying issues with deglobalization trends and others. We had a declining of equity markets in 2021, 2022. We had a resurgence as well of commodity prices and the Japanese yen collapse and all sorts of things. It begs the question, what is the next domino to fall? Now, I've started to research more about the British Empire, and during the war, Napoleonic Wars, when they were building up their own debt problem that they had at that time, it created inflation, obviously. So inflation was the first domino to fall as well. And the second domino to fall was the rise of interest rates. And at that time, one of the most important things that happened was that interest payment relative to GDP reached about 4%. And at that time, what they had to do was, it was too high. They were spending too much just to pay down their debt and not enough on the economy. So the economy began to suffer, and they had to restructure their debt. They had to run a primary budget surplus at that time and restructure the debt. And that was a time as well that there was a major devaluation of their currency. And so these are changes that happened back in the early 19th century. Which to me sort of point to the direction of where we're likely to go here. So let's go to the next slide. And to me, this is probably the most important slide of the whole presentation. It's looking at the public debt across different countries and the estimates by the OECD relative to GDP. So you're basically looking at how much interest payment relative to GDP in each of those countries. And you can see something that is remarkable is how much the US is ahead of any other country in the world. No other country is paying as much in interest payment relative to GDP than the US. You can see an example here of Japan. Now, Japan does have a larger debt imbalance in the US. And this is an unpopular view that I'm going to say right now. The U.S. debt problem is manageable, and it could even rise from here substantially. However, in order to get there, we need to adjust the interest policy. So the interest rate policy right now is inconsistent with this exponential growth that we're seeing in the debt problem. And so when you think about how currencies tend to trade, it's not about the imbalance that we have in the US. It's always a relative game, right? That's how currencies trade. If the US has to adjust the interest payment relative to its GDP to a much larger degree than other economies, that is likely to have an impact in FX markets. So I think we're on the cusp of one of the most transformative things or changes or developments in FX world that we've probably seen in a very long time. And I think that the resolution of this chart that you're looking at on the screen is that other currencies are likely to perform better than the dollar in the next, call it 3 to 5 years, in my view. So let's go to the next chart. Now you're seeing the U.S. alone. So I first showed the U.S. relative to other economies. Now let's look at the U.S. itself. Now, when we think about, have we seen one of the most aggressive hiking cycles in history? I think that's a good chart to actually point to and saying, yes. I mean, this has been completely inconsistent with the fiscal agenda. U.S. federal debt right now is somewhere close to 3.5 or so percent to GDP. Now we're looking at net interest, and this is then if you look at the CBO projection for 2034, which tends to be very tends to understate the problem most of the times. In fact, it doesn't assume any recessions in the next 10 years, which seems to me highly unlikely. It gets you about 4.1% of GDP. Look at this chart is going back centuries, 2.5 centuries, basically. And we've never seen this level of interest or cost to service the debt relative to GDP to the degree we're seeing today. Notice as well that back in 1940s and 1950s, we did see the U.S. debt imbalance be as severe as it is right now. But, what we saw during that time as well was that yield curve control and other measures actually helped the government to actually run a much lower percentage of interest payments relative to GDP. And so this was one way to allow the government to manage to have that imbalance that we had during that time. And I think we're going to go there again. Let's go to the next chart. What has been, one of the biggest phenomena that we've seen so far in equity markets and macro in general since the global financial crisis, arguably has been as well the outperformance of U.S. equities versus other places in the world. I was in a macro conference this week, and I asked the question, what do you think is the reason why we've had this? And a lot of people like to say that it has to do with the technology sector and all sorts of things. And I think that other economies arguably also solves a lot of those technological advancements, although the U.S. does carry most of those mega cap companies and large brands in the technology world certainly come from the U.S. But I would maybe point out to something that not a lot of people point out to, which is what I call it here, America's fiscal exceptionalism, which the only reason why the U.S. is able to run a much larger fiscal deficit than other economies is because it has the reserve currency status. The reserve currency status allow a country to be less disciplinary for longer. That's really what it does. And I fully understand that by being the reserve currency, you actually have to be running a current account deficit as well. Or I should say a twin deficit in a lot of cases. However, one thing is to run a deficit. The other thing is to run a double-digit deficit, in which I think that's the main problem here. But you can see at 8.1% or so, and you can also run the primary budget deficit if you wanted to, and you're going to see something similar. So this chart, the first panel of this chart, is looking at the average fiscal deficit to GDP that we saw all the way back to the global financial crisis. To me, this is what it explains. And it begs the question, can the U.S. continue to have this type of imbalance moving forward? Now, I can create a scenario here, and I would say maybe go to the next chart real quick. And you can see here the trade balance. The trade balance has been, also another thing that adds to the problem, right? We've seen that the deficit's becoming more pronounced over the years, which is, this chart would be irrelevant if we're running a budget deficit at much lower levels. Now, considering we're running, 5, 6, 7% to GDP and how much we're in government spending, when you add another 4% of trade balance, well, that starts to become very, very relevant. And think about how much is our dependency on importing oil from the rest of the world. Despite the fact that we are the largest oil producer, we still rely on sour crude because we don't produce those in the U.S. Because of the infrastructure that we actually have for refining in the U.S. requires us to actually have to import a lot more than a lot of people would expect. And so those are changes that only add pressure to this, what we call the twin deficit, which is adding essentially the trade balance, which is the current account, plus the fiscal deficit. And that's what you get, this twin deficit issue, which to me is a structural problem that creates even further pressure on the dollar versus other currencies. But let's go to the next chart or next slide. How do you manage a debt problem? In my view, there's really three ways essentially that comes down to. One is austerity by either lowering government spending or collecting more taxes. Those are basically the answers on the very first one. The second one would be through some sort of suppression of yield curve, or suppression of yields in general. Yield curve control has been one of the measurements that we've seen. We're seeing Japan doing now. We saw that back in the 1940s. There was some signs of that actually also during the British Empire in the 19th century. So there has been a history of types of yield curve controls. They all happen in different ways. And the third one, I think it's extremely radical. It tends to happen more at the end of a problem, is that debt restructuring is when you really hit a wall of debt, and you have to restructure the debt. And in some cases, it could be forgiveness of debt, which tends to absolutely kill the currency. Or it could be essentially just changing the duration of the debt. Back in the 19th century, that happened. It was basically what they did. It was they took on the debt and restructured that in a very, very long-term maturity, and created a sinking fund that would essentially allow the government to have a fund to prove to investors that they would be more fiscal responsible. We could go there. Who knows? And nobody knows what the answer will be here. But if we want to continue to have all the, this legacy on the dollar and all sorts of things, we got to take care of this. This is becoming, when I show the first chart, initially, I think a lot of people would think, I've been trading currencies for a long time. This has never been a problem. I've never seen this becoming a problem. You're right. And, net interest payments relative to GDP, if you traded over the last 50 years or so, has never been a problem. But I just showed you a chart that we're all-time highs now on that measurement, higher than any other time in the last 2.5 centuries. And the same way, like other empires, the beginning of an end necessarily actually started with those issues, with net interest payments becoming really high relative to GDP. Now, I'm not here to say this is an extreme view, that this is the end of the dollar or anything like that, although it's a possibility. This is a macro view of the next 3 to 5 years, irrespective of any political party and any political views, really. This is an imbalance that I'm not sure there's any other way to really fix the problem outside of those three options I'm giving or providing in this slide that you're looking at. So austerity, I think, will become a problem, or will become a measure as well to fix the problem at some point. But probably not the first one. We've got an AI revolution happening. We've got onshoring. We've got deglobalization, military spending. Boy, I mean, there's a lot of things that we probably need to spend capital on, that unfortunately the agenda fiscally needs to be larger than historical standards. So what does it come down to? Are we going to see debt structuring? Probably not as well. I mean, I don't think that that's going to be the case anytime soon, unless we really hit a wall here, which I'm not sure that's really going to be the case. I think the yield suppression is a much more likely scenario in the near future. And that's why I'm giving a bigger, I'm emphasizing that one as what I think to be initially the first phase of dealing with the debt problem. And if you ask me, this mandate that the Fed, this obsession that the Federal Reserve has over inflation and over labor markets, is likely to be changed either in a open way or in a very indirect way, and where the real goal or the real mandate of the Federal Reserve is actually making sure the government can pay its bills. And so yield curve control may become, some of the most important policies that we may see from the Fed in the next few years. Let's go to the next chart. And so it creates this idea, right? If the U.S. has to adjust its interest rate policies to become more consistent with the debt problem relative to every other country in the world today, because I just showed to you, no other country has interest payment on the debt as as to the degree that we're seeing in the U.S., well, then it begs the question: well, what does that do to the dollar? What does that do to other currencies versus the dollar? And if there's one chart, there are plenty of charts that I would point out to, but if there's one chart here that you should be paying attention to in terms of the currencies that have been, moving, is the British pound. It wasn't too long ago when the Bank of England suffered from an issue where basically they're doing their QT, their tightening of policies. At the same time, their government passed a tax cut from an unfunded liability issue. And guess what happened? The market got spooked, and we saw a surge in interest rates in the UK. And UK gilts actually collapsed on a sort of a short-term period. And the BOE had to kind of reverse their policy and start buying those instruments in order to suppress the yield and help the currency. So it wasn't too long ago that we saw a problem with the Bank of England. And despite all that, the British pound is breaking out relative to the dollar. Is that just the beginning? And I remember looking at interest rates. They look just like this. Back in 2021, I've looked at all these charts of interest rates, not just in the U.S. It was the case with the German bond yield. You can look at the French yield. You can look at I think the only exception really was the Japanese yen. But outside of that, even though the Japanese yen actually also moved, there was, if people remember, there was a cap on the 10-year yield that actually end up moving well above that cap later on. And I think that that's exactly the case here. And this is coming from a view of Crescat has always been very bullish on the dollar. This is a change of at least, I would say, our own macro opinion about what's likely to happen in the next 3 to 5 years. I think this is going to be a really important change here. Let's go to the next chart. Another thing that it may cause, as we see flows going out of the US dollar into other currencies, it actually makes me think about this chart. It's foreign holdings in US equities. If we see that flows of dollars, and by the way, you would think that given the fact that we have interest rate differentials, in other words, the interest rate policy in the US is much more aggressive than other places in the world, you would think that the dollar would be surging right now. And if there's anything a macro trader should be paying attention to, is when you see an asset class that should be moving up for whatever reason, there has been a tailwind, a macro tailwind in that asset, and that asset is actually neglecting to move higher in prices. And I think this is exactly what's going on with the dollar right now. And if we do see flows moving away from the dollar, this could have a lot of ramifications and implications in global assets. And I think this is one of them that could also, wouldn't surprise us because, we've been bearish in equities. And I think this could be what it could tip over a lot of things. And maybe that's the one too. So you're looking at the U.S. allocation as being basically saturated. And we're at levels that we saw back in the tech bubble. Where is the money going to come from? It's a very good question, especially if the U.S. at some point has to hit a wall and even have to run some austerity measures to cope with the debt problem. So let's go to the next chart. So now you're looking at a regime change. 2-year yields, they broke out of a very important resistance, as you can see there. That's what, to me, marked the inflation era. When I saw that, and I remember looking at this chart prior to breaking out, and a lot of people had very strong views about this, that we would not see the 2-year yield because we've seen too many times it bumping at that line. And this is going to be another one of those that we're going to see a major decline. And guess what? We did see a breakout. And now, in my view, after seeing folks go on from 7 interest rate cuts in the curve to now two interest rate cuts, I actually think there is a very strong possibility we could see 2 things: inflation reemerging even more, and number 2 is the actual multiple cuts in interest rates because of the debt problem. And that's what happened also in the 40s, right? Allowing inflation to run hotter than historical standards is how central banks and economies tend to deal with, very large debt imbalances. And I think the Fed and the U.S. is likely to be dealing with this the same way. And so it wouldn't surprise me if we have a decline of 2-year yields to back to their to that resistance line that is likely to become a support, in my view, as we see things. And this is a big move, a 4.6, 4.5% on 2-year yield all the way back to 2%. That's a very, very large move that is definitely not priced into the curve at all. And so anyways, this is another way of thinking about those flows. But let's go to the next chart. Now you're looking at the 3 months versus a 10-year yield, with this one of our views as well, in terms of a way to trade or to think about where interest rates are likely to go, which is the steepener, the steepening of the yield curve. In other words, is the probability of the long end of the curve starting to rise more than the short end. We have a very strong view about this. We think that we're going to see another abrupt move of the steepening of the yield curve, which tends to be very recessionary too. If we go to the next chart, this is another measurement that we actually created this indicator. It's a percentage of yield curve inversions, which remains at about 76%, but we're seeing inversions going away every day. In other words, if you look at all possible spreads of the yield curve, we used to have close to over 90% of the yield curve was inverted, and there's 45 possible spreads in the treasury curve. And if you look at those 45, 90% of them were inverted. So right now we're about 75% or so. Can we see a return back to zero? Yeah, we've seen it many times in history. After major inversions, we tend to see the other side of that. We think we're going to see that again, and that tends to be very recessionary as well. And if you want to pay attention to the gold standard of recession indicators, that's in the screen right there, and that's a screaming recession ahead in our view. Let's go to the next chart. I'm almost done. Now, if you have a view on 2-year yields, if you think 2-year yields is likely to fall for all the reasons I just mentioned, mainly the interest debt payment relative to GDP, then you would suspect what would that cause? And usually what we tend to see is this relationship between gold and 2-year yields. When 2-year yields fall, we tend to see gold rising. And by the way, I want to give credits to Ronnie and the guys from Increment and AG, because although they didn't do this chart, they did something very similar that actually inspired me to go and create this chart. So I'm giving credits to them because I think that's the right thing to do. But I think this is an important sort of moment as well for gold, because seeing those changes on the dollar, to me, is what it takes gold to have its next leg up. And not only gold, but other metals as well, which we've been very constructive in those and that asset class overall. Let's go to the next chart. I'm trying to go a little quicker now. So there's been a macro regime shift back in 2020 when policymakers, the way they responded towards the pandemic, and that created finally a break of a long-term declining trend of commodity prices. Where are we now? We've been consolidating on that trend. In our view, this is the beginning of a upper movement that is likely to take a full decade of, or a secular a bullishness in or bull market in commodities, or a commodity super cycle, whatever you want to call. I think all those are appropriate ways to talk about the opportunity in this hard assets, but particularly in commodities. And we tend to like the metals a lot more, but really all sorts of commodities should, and in our view, are likely to benefit in this macro environment. Let's go to the next chart. And then you look at allocations. U.S. family offices barely own commodities. That's what makes something asymmetric, is when nobody owns it. And so seeing this is only adds to the thesis. Now I'm going to make the last point here, which I used in a chart, this chart for the prior presentation. If we go to the next one, you can see here something that I think it's somewhat bizarre, but also I think adds to the whole idea. Is really looking at the private fixed investment in the mining industry. Used to be about 17% of GDP back in the 60s, and now it's about 0.3%. I think this explains a lot why the mining industry has been underperforming. Is the lack of capital entering the space in a large way. And yes, there has been a lot of technological changes that have efficiently changed this industry, but that doesn't explain this huge shift from a sector, an industry that used to be so relevant, and now it's become basically completely ignored. In our view, metals, and I think one of the things that really answers in this chart potentially, and the reason why we've seen this declining trend is globalization. Is us depending more and more on imports of ore overall, and metals. And I believe that as these deglobalization trends, so we see the break of that globalization trend in 2020, and now a total change of regime in terms of geopolitical risk. I think that mining could become a critical industry again, and if that's the case, capital needs to be returning to that industry in a very significant way. Now, am I saying we're going to go back to the 17%? Probably not. But certainly, in our view, 0.3% is also, too low, and so there's a lot of room for growth, and in this industry, and that's, I'm going to just repeat a phrase from Senzel. Great money is made where there's a true lack of capital and capital interest in an industry or in a company, and this to me is the definition of that idea right there. I think this is my last chart. But I just want to prove that. I might have a chart of mining. Yeah. Notice yesterday, the gold prices were down about 2%, and mining stocks were down about 2% as well. Those are not usual trends. Pay attention to those things, because I remember presenting this maybe 2 weeks ago, showing a chart of gold from the 1980s to the early 2000s, and it was down about 70%. Imagine creating a segment and talking about why you thought gold prices would go up from there. And by the way, that was exactly the bottom of gold prices, went up from $200 to $300 all the way to what it is now, $2,400, $2,500. And so, can we see something like this in the mining industry? Those are the things that a lot of folks believe it's unthinkable. I do think that that's going to be the case. It's been one of the most unsupported historical views that the mining industry will not follow gold prices, and that's just not our view at all. We think ultimately gold prices do translate into better margins, and it ultimately translates into capital coming back to this industry. And notice what's happening with copper prices and copper miners. Copper miners are seeing inflows of capital. Yes, it's coming from the electrification and all sorts of things. But, in our view, that also will drive the openness to the overall industry that should at some point drive capital back into the mining space, especially in the gold and silver space as well. I think that's it. I'm going to pass it on to Quentin Haney now.
Tavi, hold on just a second. I gotta put a note in my phone I gotta refinance my mortgage when 2-year yields go back to 2%. Let's see. Okay, refinance mortgage. I got it in there.
Hey, don't do all that in 2%. You're gonna have to roll it again a lot higher, man. Don't do that. I'm kidding.
No. I want to refinance it at a lower interest rate. As soon as it goes back, we'll grab that. Whatever, I don't know what mortgage rates would be if 2-year yield falls to 2%, but I bet they're going to be a heck of a lot lower than they are now. Anyway,
I would agree.
Just my twisted sense of humor. Got quite a bit to talk about today. The first part, look, I'm trying to shake things up a little bit. I like to provide at least some educational stuff, we'll call it, for viewers to chew on over the weekend, whatever, to learn a little bit more about mining and how things work and why we make choices like we do. I got a lot of updates. Okay, in fact, today I've got like 4, I think, 3-dimensional models to show people. So we're gonna have to get cracking here, and I apologize, but I'm gonna blast through this. Okay, so what you're seeing here is a very large truck. Call it a haul pack coming out of an open pit mine. All right, it's full of rock. Can't see the rock because it's up inside there, but it's full of rock, and that truck now has a decision to make, or I should say, people have made a decision for where that truck's going to go. It's either going to go to a waste pile and dump that rock off. In other words, it basically is of no commercial value, and they're going to dump that rock into a pile that will be reclaimed at a later date, we'll call it, or it's going to go to some sort of processing plant, whether it's a mill or a heap leach or whatever. It's going to go to a place where the metals in that rock can be extracted. Okay, now what determines which way this truck goes? Well, cutoff grade. Okay, but how do we establish cutoff grade? So I want to just give a 101 level. And look, this isn't perfect, okay, but it's good enough to give people an idea of how cutoff grade is kind of established in an ore body, in a deposit. All right. So let's go to the next slide. I just grabbed this cross-sectional view of a block model. It's an open pit schematic view of some block model for some deposit. I don't know where, but I grabbed it just for illustrative purposes. Okay. You can see here there's a series of colored lines that show where the pits are, and obviously they're going to take these pits down in stages, red, yellow, and blue. Don't worry about that. Okay, that's not what I want people to focus on. What I want people to focus on are the blocks that you see here. Now this is copper. Okay, it could be gold, or it could be anything, but notice that the orange blocks are considerably lower grade than the pink and the purple blocks. Okay. In other words, the orange blocks are basically kind of at the lowest end of the spectrum in terms of grade. Well, what defines the boundary between an orange block and white, which in this case would be waste? Okay, cutoff grade. Okay, so that, I think that's pretty easy for everyone to understand. There's value in the rocks that are in the orange blocks that's of commercial interest. There's not enough value in the blocks in the white, or the absence of blocks, I'll call it, in the white areas. Pretty simple, all right? But what defines, okay, so go to the next slide. So I'm going to give a very high-level answer to answer this question. What defines cutoff? Go to the next slide, please. Maybe is it stuck here?
Might be stuck, but I'm going to, oh,
there.
no, you got it. All right.
There it is. Okay, this is a general answer. It's not perfect. There's a few nuances that I could have put in here, but I felt let's kind of pare it back to something that's digestible. All right. So basically, it's the value of recoverables or / payable metal. Think of the NSR value, the net smelter return, like what you get paid for that metal in each ton of rock, is sufficient to cover the costs to process it, as well as ship and sell the product. Okay, so basically a blob of rock coming out of the mine, depend whether it goes to a waste pile or to the processing plant, is going to depend on whether you can get more value out of that ton of rock once you recover it. Look, you've already spent the money to get out of the pit, right? That truck was at the top of the ramp, so the cost of drilling, blasting, and excavating, and then hauling that rock up to the top of the pit, that's already sunk. Okay, so what defines it from that point? Well, it'll go to the mill or the heap leach or whatever. If you can get more value out of it, then you're going to have to put into it to process it. Think of it. That's pretty simple. Okay, if you can't get more value out of it, you're going to be losing money. So you're going to chuck it in the waste pile, or maybe you put it in a low-grade stockpile or something like that. But that's what determines which way that truck's going to go. Everybody okay with that? Hopefully. All right, let's move on. Let's go to the next slide. Okay, so I'm gonna run through two scenarios. This whole discussion that I'm presenting today, so Jay Taylor emails me every once in a while, and he asked me this question this week. Just kind of a fundamental question, like, what makes a heap leach operation versus what makes a milling operation? And I thought, this is pretty good question. Like, let's answer it. And again, I'm trying to distill this to just a basic, very clear answer here. So what I've presented here is, the metrics. We'll say rough metrics that you would expect for a heap leach operation. Range of recoveries. Low end, you might see 50% recovery of metal out of a heap leach. High end, if you're really super lucky, maybe 90%. But most of the time, most of these heap leaches get an average recovery of about 65%. I mean, to be frank, that might even be a bit generous, maybe more like 60%, but whatever. We'll call it average recovery of a heap leach around 65%. That means of all the metal that's in that rock, you're going to get about roughly 2/3 of it out when you process it in the heap leach. Okay, now the cost of a heap leach operation, look, it can vary dramatically from place to place. It depends on how much water is available and other factors, topography, weather, blah, 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 blah. There's a whole bunch of factors that play into it. But I'm just going to say around $7 or $8 per ton, okay, to process. All right, interesting. Go to the next slide. Let's do a study of milling. Okay, again, these are just high-level numbers, but I'm going to throw them out. And by the way, this is for gold. I want to make clear, this is gold focus. Okay, this is not copper. This is gold focus. All right, so in a milling scenario, gold mine with a milling operation, you're going to have range of recoveries on the low end, probably 80%. Think about it. If you have less than that, there's something wrong. Metallurgically, there's something wrong with this rock. Okay, but 80% low end, you can get some deposits that are fantastic, nearly 100% recovery. We'll say 98% for the high end. Average recovery for a gold ore around the world in a mill, maybe 93%. It's pretty good. Okay, you get most of the gold out. All right, and the cost to process, maybe 22, $24 a ton, somewhere in that range. Okay, 25. I don't know. I think I cut off the range part of it here, but we'll call it $22 to $25 to process a ton of rock. Now that's been going up lately because the cost of energy is going up. All right, so we're seeing costs increase. In fact, I think Newmont put their numbers out this week, and the thing, everybody's focused on how much money Newmont made, which was great. Okay, wonderful, and it's mainly because the gold price, has lifted over the past quarter, and they've got a lot of room to make some money, margin. But the thing that I focused on when I read the report, their all-in sustaining costs is like $1,560 something. I mean, we're getting close to $1,600 an ounce. It's that's a worry. Okay, darn mining, darn inflation, whatever. Okay, let's go to the next slide. Okay, so what I've done here is I've put together two scenarios. Here, there's my range. I think I cut it off on the previous slide. There it is. It popped up there. So 20 to 25. Okay. All right. I've got a scenario here where we have a rock, a ton of rock. Okay. It's got 0.6 grams in it. We're going to decide if it's going to be more efficient. In other words, is it going to be better to process it in a heap leach or a mill? Okay. So I've just put some numbers in here. So we got 0.6 gram both sides. Recovery, there's your recovery, 65% for heap leach, 93% for a mill. It shows you how much gold's recovered through that processing. And the little thing in brackets there, the dollars, that's at about $2,300 gold price. Okay, so you're going to get about $28.50 per ton of metal of gold out of a heap leach, whereas you might get 41 out of a mill. Okay, now mining, including stripping, I just kind of picked numbers. In this case, I was thinking, okay, 5-to-1 strip, $2 a ton to move rock. So you're moving 1 ton of ore and 5 tons of waste. Okay, that's 6 tons. 6 times 2 is 12. Okay, that's why I put that in there. And I've kept it on the same on either side. That way we're comparing apples to apples. All right. It's really the cost of processing that's the different item here. Okay, so cost of process, I gave $7 to the heap leach scenario and 24 in this case to the milling scenario. I think that's reasonable right now. Okay, future, you got to factor in reclamation costs. It costs money to reclaim your mine site after you're done, so you have to figure that in. Okay, G&A also has to be figured in. These are numbers I kind of picked out of a bit out of thin air, but they're realistic within most mining operations. All right, so let's add up the costs. Okay, we've added up on the heap leach side. We got $24 per ton. Over here on the milling side, $41 per ton. Well, if you look at the amount of dollars of gold you get out, you have a margin. You get about $4.50 you're making on that heap leach on a per ton basis. $4.50 of margin. All right, cool, easy to understand. But over here on the milling side, even though your recovery is higher and you're getting more gold and, $41, wow, great, but you're not making any money. Okay, so this shows you why it's less, it is less likely that low-grade materials like this are going to be able to be milled efficiently and make money, especially when you consider the cost of capitalizing one or the two. Heap leach is going to be relatively cheap to capitalize. Milling is going to be relatively higher costs to capitalize. Okay, so right there you can see, for low-grade materials, non-refractory gold ores, heap leaching is going to make a lot more sense than milling. Okay, but let's look at another scenario. Go to the next slide. Let's go to it. There's my X. Bad, right? No milling, 0.6 gram. Now you might say, well, there's mills operating around the world that are, look at Paracatu in Brazil. Yeah, there are some. And you know what? The capital is already sunk in those projects. It was sunk decades ago. And so they can, because of scale of the mills, they can run efficiently and get the cost of processing down to maybe $10 or $12 per ton, whatever. So there are some exceptions. Don't shoot me. Okay, but in general, 0.6 gram rock, you're not going to mill it. Go to the next slide. Okay, let's look at 1 gram. So I've kept everything the same recoveries. In this case, you can see we're getting 0.65 grams gold in the heap leach. We're getting 0.93 over here on the mill. Stripping, mining and stripping, same numbers there. Cost of processing, same. Future reclamation, the same. G&A, the same. Okay, total per cost, 24 over here, 41 over here. Okay, now if you just look at the margin you're going to generate, it's about 24 on the heap leach side. Okay, but over here, it's almost the same, to be frank, on the milling side. And 1 gram grade, you kind of gonna make, it's kind of like, one or the other. It's going to be a pretty simple decision. But now let's bring in capital and look at the picture a little bit more. Let's go to the next slide. Okay, let's just say for giggles. Okay, let's say the mine that you're making has 125 million tons of rock. Okay, I'm going to say let's factor in the capital needed here. It's about a $250 million project for heap leach, so that's roughly $2 a ton. So throw that into your equation now. Okay, that's interesting. Now go over here to milling. A mill is going to cost more to develop the tailings facility, et cetera, et cetera. We'll call it $4 a ton. Okay, you can see now if you factor this into the equation and the resulting net margin you're going to get, including the capex as distributed on a per ton basis, is about the same number. Okay, so at 1 gram, it's really the way you go is dependent on whatever technical decisions you make. You could heap leach and do pretty well. You could mill and do pretty well. Maybe there's something that says, hey, it's going to be better to heap leach here than it will to mill, or maybe vice versa. You don't. Anyway, the point is at 1 gram, it's a kind of a trade-off, at least in current economic conditions. Go to the next slide. Now, let's go to the higher grade end of the spectrum. Okay. So now we got 2 gram rock. Okay, and this is where it gets important because stories like Valley, for example, Snowline, they're 2 gram or even over 2 gram rock. Okay, well, 65% recovery, 93. Okay, that means we're getting 1.3 grams over on the heap leach, 1.86 on the milling side. You can see there's a big difference in the amount of gold, the dollars of gold that we're getting out of each ton of rock, 100 or 96 versus 137. All right, that's a big darn difference. All right, everything else I've kept the same. Boom, 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 boom. So keep it simple. All right, look at down at the bottom margin. Okay, you're making $72 a ton on the heap leach side. That's pretty good, not bad. But look over here on the milling side. You're making $25 almost over that. Okay, why would you leave $25 of gold in a ton of rock if you can get it out with a mill? Okay, in other words, in this case at 2 grams, you're not going to heap leach. You're leaving too much gold in your heap. There's so much revenue or so much metal value in there that you'd be stupid not to build a mill, especially, and go to the next slide, when the capital, remember, is on this level of difference. It's a no-brainer. In other words, in this case, you're going to tip the scale, you're going to mill this rock. Makes sense? Okay, now there are some deposits where you might have a big volume of 2-gram stuff or 1.68 gram stuff or whatever, like pretty high grade stuff. And then you might have a big cloud of low grade, and you might want to do a hybrid of the two. For example, the Fort Knox mine near Fairbanks, it started as a milling operation in 1996, I think it was. They started as a milling operation, operated that way for many years, I think over a decade. And then they actually built a heap leach as they got into the lower grade part of the ore body, and the economics kind of shifted towards that end of the spectrum. Guess what? Then they're operating heap leach here. Okay, so that can happen too. But I hope this gives people enough information that you can start to rationalize now why some operations might be more favorable, particularly grade wise, more favorable as a heap leach versus milling, which is geared towards higher grade deposits. You're going to mill. All right, makes sense. All right, so that's my soapbox for today. Gone. Let's go to updates. Okay, we're going to jump right in. We're going to talk about Snowline today. Do you have a question?
No, I was going to say that was awesome, Quentin. That was really cool, man. That was great. Good stuff.
All right. Cool. All right, good. And if people have questions like this, if you get a message to me, and look, I did get some recently. There was one guy that asked for, he wanted me to talk about channel sampling or something like this. I will try to get to some of these questions. Okay. I felt this one was appropriate for this week, but I'll try to answer questions if people throw stuff at me. All right, more and more. Anyway, go to the next slide. Okay, Snowline had absolutely fantastic results announced this week. Look at this, 404.8 meters of 2.3 grams per ton. Inside of that, really up at the top of this, there was 100.8 meters of 4.7 grams per ton. That is disgustingly high grade. Okay, I mean wonderfully high grade. Sorry. These are some of the best holes I've seen in a long time come out of any project in the mining industry. The uniformity of grade in these holes is to die for. In other words, it's not driven by little high-grade nuggety pockets or whatever. Go to the next slide. You can see that in this table. Look, they did capped comparisons here. Okay, so they have the grade in grams per ton. You look up there at the top, top right, okay, up in the corner. 1.77, but if they cap it at 10 grams, guess what? There weren't any assays that were over 10 grams. Okay, therefore, the capped grade is the same as the reported grade here. It's 1.77. Little bit of a change, little tiny bit. There was like one assay. There's 16.8 grams, and then a 32 grammer down lower that shift the grade a little bit. But otherwise, this stuff is just, it's like the bowl of soup analogy, guys. It is a giant bowl of soup, bowl of gold that is very well behaved. Anybody who's a grade control geologist here could probably go on a 2-month holiday and come back, and the mine will have operated without any problems whatsoever. Okay, now what does this data mean? Let's go to the next slide. I do have a 3D model, by the way. Okay, so there's just 2 holes in this news release, and you say, well, look, these are in the middle of areas they've already drilled, whatever. And I hate to hear things like that because they're actually very meaningful, okay? And people that just don't know what they're talking about spout off like this at a time when the company is trying to actually show something very meaningful. So I'm going to try to elucidate. Now, first thing I'm going to show will be cross-section. But before we move on to that, cast your eyes on this plan view. This is a plan view. So we're looking down like a bird looking down on the ground, okay? You can see the company has a lot of drill holes they've already completed this year. Those blue dots with the line, and then there's little yellow stars, or bloody hard, or yellow dots, I guess they are. Little tiny dots. Those are a preview of things to come. Okay, I'm going to start in the upper left, and I'm going to work my way down to the lower right here. Notice the hole that goes cattywampus off there, going off from east to west. Look at all the yellow dots there. That's a big area where there's no perceived mineralization right now, And that hole, as it went down into the ground, they're seeing visible gold the whole way down. You think that might add some tons? Yeah, I think that could be a really good outcome. Okay, next thing I'm going to point out, there's a series of drill pads along the northeast margin. So go upper right, you can see some blue dots, and even in interior there's some pads in the middle. These holes are very important. Why? The ones in the northeast go underneath the existing drilling, and they're seeing yellow dots the whole way down. The whole way down. Okay, look at the yellow dots. Wow, look at what is that? Hole 83, I think it is. Just yellow dots the whole shebang, the whole way down. 77. But also the ones that go the opposite direction see the same thing. I can't read the numbers. Sorry, guys. I think 75 and 70 something other. Yellow dots the whole way. Okay, there's going to be a lot more gold found this year in areas, and these guys are smart. Okay, they know where they have gaps, areas that they haven't drilled, whatever, that they need to shore up to grow this resource. Now, the last place I want to cast people's eyes down is this area in the lower right. It's kind of hidden behind the legend. I wish we could take that legend off and throw it off to the side for a bit. But you can see there's a hole or two tucked right underneath that legend where there's yellow polka dots down the entire bloody thing. Okay, now last year when they left off drilling, it was very clear that the deposit is open down plunge on the southeast end. Guess what those holes are telling us? The thing is wide open. Okay, could this grow? Yes. Okay, it is not static. This thing is growing in multiple directions, including infill, but it has a lot of room to grow, and I think the company's doing a fantastic job prioritizing their drilling to test these ideas. Go to the next slide. We're going to look at cross sections now. This shows you that 450 meter interval of 1.77 grams. You can see right away that it fills a pretty big gap between two holes. I think it's 10 and whatever that is off to the east. There's almost 200 meters between those holes. Okay, so to have a hole in between here, and it confirm all of the high grades that we're seeing, if not even enhance the grades. Look at how far down that hole the grades continue. I think is a very good outcome. Now, look at the hole that scissors. It goes the opposite way. Okay, there's another hole, and they see yellow polka dots down the whole thing, even down towards the bottom. Okay, so down at the bottom, there's a lot of little gray blocks, you see. If the assays come back from those with pretty good gold, there's a whole bunch of gold they're going to add down the low part of that drill hole. That's a great outcome. Let's go to the next slide. Same thing here. Okay, so this hole 72 kind of fills a gap of about 100 meters between the two pre-existing holes, number 48 and 39, I believe it is. Great. It also extends gold down deeper. Okay, I think you're going to see expansion of blocks in that area with that will now be upgraded, probably both in terms of grade as well as confidence. So, it increases indicated level of mineralization. Now, there's two holes I want to draw your attention to. One is the yellow polka dots going down the next hole, which is hole 75. Look at all the way to the end of that hole. Yellow polka dots, the whole shebang. Look at all that stuff down, those blocks down in that area. Very low grade, kind of that, fuzzy end of the spectrum grade. Not anymore. I think we're going to see extensions down there. And I would say that hole 74, which is way over here on the right-hand side, it goes down. Look at right at the end there. There's a whole bunch of yellow polka dots crammed together. Wow, that's a lot of gold that can be added to the system. All right, so that's wonderful. Go to the next slide. Okay, before we go on to Jupiter, let me okay, this week I really hope this doggone thing does not give me fits. Okay, we're going to click on that one. You guys see this, right?
Yes, now we do.
Hallelujah. I don't know what computer glitch there was last week, but man, that was annoying. Okay, so here's our two holes from this week. This is simply the model of drilling, okay? I'm going to highlight those holes so people can see them for reference. I actually tagged one of them right here with a little blue pointer. Okay, so there's one of them, and it does infill between this hole and this hole. Very, very stout infill hole. And then there's another one Sorry, I got to tip it up so I can see the collar label. Let me see, where is it? It's that green one back there. There it is. I think it's this guy right here. Okay, there. Boom, that guy right there. Very high grades up here, but it continues all the way to the end of the hole. Good grades down to the end of the hole. Okay, so those fill in things, but let me just highlight the areas that they are now seeing stuff. Look, I didn't plot up all the little yellow polka dot holes, but I'm going to tell you this. First of all, we're looking northeast, guys. Stick with me. Sorry, I'm not to get spastic when I'm looking at these. There's one hole that went off this way. Saw a bunch of yellow polka dots over here. I think we're going to see growth on the northwest end of the system. We saw over here several holes that come underneath here. Lots of yellow polka dots in basically this area right here. So I think the thing is open to the southeast down plunge. I think we're going to see a big addition of mineralization in this area. And then on the back side here, okay, we had several holes coming underneath here. You remember the TP that are, tent shaped thing that I talked about? Okay, there's a big void of drilling underneath here, like in this area. And I think we're going to see a lot of tons added down here. Okay, everybody's like, the 7 point whatever million ounces, is that it? No, it's not it. Okay, I think there's a lot more to come. Michael Gray does a good job of explaining it too in his write-up. He's with Agentis. If people want to get on the internet, look it up. This thing's got a lot of room to grow, guys. Okay, so I do think this is an exciting result. I'm going to stop sharing. We're going to go back to the deck. There you guys, a lot of jumping around today. Okay, now we're going to jump up to Jupiter. Now, you remember they cleaned up the land ownership around Jupiter. They had a minority partner in there. It was a little awkward. They basically cleaned them up with a shared deal, I believe it was. Didn't, take any significant capital out of the company. And it really cleaned up 100% ownership of that Einerson project, in particular Jupiter, which is that star, that northern star of the two. Valley is right in the center of the image, more or less, and then Jupiter's a few tens of kilometers to the north. Now, are these related? Yes, in a way. But Jupiter's an orogenic gold system. In fact, it's a shallow, we'll call it, epizonal gold system, probably. Could it be related to intrusive activity? Well, there's a lot of intrusions around here, so yeah, it could. Okay, but I do see it as an orogenic system, and I think it's a big one. Okay, go to the next slide. Okay, so apparently Snowline, I talked to Scott this week, and apparently Snowline has hired a person, a specific geologist who's focused on Jupiter as a project. I haven't met this person, I haven't talked with him, but it sounds like the guy has very good experience with orogenic gold systems and structure, okay, which is good because there's a lot of cover in this area. There's like kind of gravels and stuff that cover a lot of the rocks in this area. And really it requires interpretation of drill core to understand what's going on. But this guy or this team that's working at Jupiter, this is not part of Valley. This is 40 odd kilometers north. They have done a fantastic job of building an understanding of this ore system. And I think it's a remarkable, like a very large scale picture that's coming together. What are we looking at? Well, the blues and the yellows are basically bedded stratigraphy. Okay, they're beds of sedimentary or metamorphic rocks that have been folded and tipped up on their end, more or less. All right, so we're looking at plan view over here. Why are we looking at? Well, they're just showing us where they've poked some holes recently. And I think it's mostly down towards the southern area here where they're following up. There were some great results in 2021? I can't remember now. It's ages ago. But they had fantastic, many 100+ gram meter holes out of this project. Very first bat, bam, they were onto a discovery. Okay, now we get to see how this follows up. All right, so what's the takeaway here? The takeaway is on the right-hand side. Okay, so look at the two holes they got that they put in already, this 22 and 23. They also have 24, which they talked about in the news release. It's off section. But you can see this guy went long. I love this. Like Scott was like, wow, he's really aggressive. It's a little spooky watching him drill, several hundred meters away. And I'm like, Scott, for the love of God, let him do it. I love it. I just love to see somebody rock up to a project like this and go, yep, I feel like this thing is going to go down 150, 200 meters or whatever, and poke some holes down there and hit. Okay. So this isn't a dream. Okay. What they're doing, they've drawn a cross section here where they're seeing veining. They don't have assays. Okay. For those deep holes, don't have assays, but they're seeing the quartz veins like they saw in the previous holes. They're seeing this, sulfide disseminated zones around the quartz veins, mineralized zones. Okay. Do you think we're going to see some good news out of this? I don't know. This looks pretty good to me. Okay. That looks, yeah, I think so. Okay. I can't guarantee anything. And I'm about ready to crawl out of my skin because I'm so excited. But this looks pretty darn good. Okay. No promises. Can't promise anything. But I love to see the big step outs, the big thinking. And I love to see the multiple zones of mineralization they've encountered. Imagine projecting this along strike for a couple, 2, 3, 4 kilometers, right? And it could easily be that big. Could you fit some gold in it? Yeah, this could be a big puppy. Okay, this is pretty exciting. The other thing I got excited about, go to the next slide, was the fact they saw visible gold. Okay, they report seeing visible gold. This is their just gentle way of telling the world, oh, we're seeing veins, mineralization. Oh, and by the way, we have a little bit of visible gold. Okay. Look, stay tuned. Okay. I know these guys well enough to know they're the biggest bunch of sandbaggers you'll ever meet in your life. they'll always understate or under promise and over deliver. I don't want to hold them to it. I'd feel bad if, but I do think this is going to look pretty good. Okay. Go to the next slide. Now we got to talk about 2 other projects they're drilling, or actually maybe 3. So Cujo, look in this map, the red blob road, and look to the far left. You'll see a project called Cujo. There's one, and then I think Sydney, which is down in the Cynthia block in the blue. It's towards the north end. That's another one. Go to the next slide. Let me see. Yes. Sydney and Cujo, correct. Okay. So Cujo, they talked about drilling 3 holes. They did test 3 holes there. Lots of sheeted quartz veining, which was to be expected. I think we talked about Cujo last year. Now, did they see visible gold? No, they didn't. Okay. Does it mean it's the end of the world? We don't know yet. They did see bismuthinite, which is an important trace element or mineral that occurs with gold frequently in these systems. But look, when I asked Scotty, I said, what's your view on Cujo? He says, well, we didn't see the VG like we saw at Valley. I said, well, okay, we'll just see what the assays say. No promises here. Maybe it comes back a bit lower grade or something like that. Who knows? Okay, whatever. Life happens. Okay, but Sydney target, I'm now getting more excited about, and I'll tell you why. It's because they actually saw VG in some of the veining here. Okay, so look at the photograph, and again, this is very typical of Mr. Berdal. He puts out these wonderful, beautiful outcrop photos. Look at the one at Valley. That's the original photo. That's the Discovery outcrop there in the creek with the little veins going every which way on the right hand side. But he used the one over here on the left to show Sydney. It looks a heck of a lot like Valley. Okay, so to me, I think just reading his language on the phone, I think he's pretty excited about this. Seeing the VG and the quartz veins and stuff. He says, yeah, in scale wise, he thinks this one looks like Valley. Okay, so they're going to drill it. All right. But do we know if there's anything there yet or not? We don't know, but it looks pretty good. Okay, it looks pretty good. So we'll sit tight. Maybe they can deliver another Valley. All right, let's go to the next slide. Now we got to talk about First Nations and exploration in the Yukon. Okay, good, bad, and ugly. All right, the Victoria mine incident a few weeks ago was an embarrassment to the mining industry. It's just ridiculous that something like that would happen in this day and age. I hope to heck that through their investigations they figure out what happened and why it happened, and how they cannot do it again, because stupid stuff like that cannot happen and have a viable mining industry. Okay, now there's been quite a bit of angst over this event. Everybody is, investors, geologists, engineers, the government, First Nations, everybody's been anxious about this situation. What do I hear through the rumor mill? And look, all I do is hear through the rumor mill. I'm not on site. I don't know people personally, whatever. But, in general, the feedback I've gotten from technical people is that they will be able to manage the mitigation around this heap leach, and they can likely get the operation going again. So that's the first piece of good news. Okay, yes, they do have to address this problem. They can't just go, oh, let's stack it up again and get going. Wow. No, they got to figure out the problem. Okay, so that's still open ended, but at least there is a general view forming that they can probably resurrect this. Whether it's Victoria or not, who knows? I mean, this is it's challenging. Okay, now the other thing I've heard, okay, is that they have more or less the treatment of waters contained at this point, and they're processing the waters, and that's mitigating any issues with materials getting outside of the mine site. That's good to hear. Okay, because we don't want stupid stuff like that happen. We don't want to contaminate the environment. I mean, this is very simple. We're all human. We all got to live here, and we all got to perform our best. Now, the Nacho Nyack Dun is the same First Nations that has territory over Victoria as over here at Snowline. Okay, it's a pretty big territory through the kind of central Yukon or east central Yukon. Wonderful people. Last year when I was at site, there's a lot of folks from First Nations who do have work, or they have like the solar panel business that's providing energy for Snowline's camp and so forth. There's a lot at stake here. A lot of people are employed in this project, and right now, Snowline, as I understand it, Snowline is operating within the current permits that they have for exploration, as well as through their current agreement with First Nations. Yeah, that's good. That would be expected. I would not want to see anything otherwise. Now, everybody in the Yukon, First Nations included, know that there's a lot at stake here. There's a lot of jobs. There's a lot of good things that could come to people, First Nations as well as others, over time. In other words, the Yukon is kind of at the cusp where they can grow their economy, and the people are going to be the first beneficiaries of that. Okay, there's roughly 45,000 people in the Yukon. Nobody's going to make light decisions here. I would say that the fact that Snowline is continuing to operating is very comforting. I know that Scott has talked with folks. This is a good sign. Okay, I'm not saying I'm on the front line and I know exactly what's going on, but it sounds like they're able to continue operating. Now, I'm going to throw something out there that, and I hope people watch this video. I don't know who watches this video, but I hope Nacho Nyack Dun listens to this video, for Pete's sakes, because my view of the mining industry right now is that we don't have enough skilled people in this industry. Okay, truly, I don't think we have enough skilled people. I don't see enough geologists or engineers or environmental scientists or hydrologists, or you pick your favorite technical person you need to run the mining industry. We don't have those. Okay, so I'm going to get on my soapbox for a minute here. I'm going to tell you where I want to go with this. I'm working like mad. I'm spending a lot of my time right now working with professors at the Colorado School of Mines here in near Denver to build an institute. We have established an institute called the Earth Resource Innovation Institute, and our goal is to educate the next generation of technical people in the mining industry. I'm sending a large number of Bolivian students up to the School of Mines here shortly to be part of this program. Over time, I hope to grow this. Other companies are now expressing interest, and I think we'll see students coming from all over the planet. But it's wonderful to see the ranks of students getting taught increase at School of Mines. Okay, here's my offer. This is an offer. Okay, if there are First Nations students, 18, 17, 18, whatever, young folks who want to build a future in the mining industry, like as a technical person, a geologist, an engineer, environmental science, come talk to me. Okay, I'll even figure out how to support them. Okay, I don't know how many students I'm me and others are working to support here, but I will figure out how to support First Nations that want to join the mining industry and make a career out of this, because there's no better way to make sure stuff is run right than to have your own people educated and operating, working in these positions. In Bolivia, our entire workforce, with the exception of maybe 2 or 3 people, is Bolivian. They're wonderful. They're great operators, very, and that's the way it should be. The people in that area should be the first to benefit from mining. Okay, I will tell you. Okay, so send students to me. We will look at what we can do. All right. Go to the next slide. Goliath had news out today, or not today, this week, about more visuals in drilling. I got to show you this in a 3D model. Okay, this is the schematic rendition they have showing the sherbet zone, which is the upper orange, pancakes there. You remember my baklava? Everybody made fun of baklava last week. I'm sure people went out to eat at their favorite Greek restaurant though too. Anyway, you got sherbet zone, and you've got the other zones that they found now, the Golden Gate, the Bonanza zone, etc. And they're finding more. Okay, so this thing is like a stack Jenga tower of lodes. Remember the baklava, the little layers with the walnuts? That's what we're looking for. That's the ore. Okay, but down below, there's an intrusion that's driving this puppy. Absolutely, hands down, clear-cut connections. One of the few ore systems I've ever seen where you have a defined connection between the mothership and the deposit that it formed. All right, go to the next slide. So in this hole, this is, I believe it's hole 37, they found down deeper, they found the hole went into these intrusive rocks. Okay, notice the color and composition of the 2 rungs of core up towards the top left. It's kind of a speckled granodiorite. Where have we seen this before? Well, it looks to heck like a reduced intrusion to me. Okay, I'm starting to think, like, my brain, it just like, holy cow, this is nuts. Anyway, they're starting to see evidence of a reduced intrusion perhaps driving this thing. And there are veins that are crisscrossing this thing. You can see that in the images where they see VG in this. Now, I'm not saying, oh, there's a snow line down there or whatever, but I'm just saying that's really interesting. Okay, the company has seemed to figure out very quickly here in the program this year that there is likely a reduced intrusion of some sort that is driving this gold system. What does it mean? I don't know yet. But I'm very interested, okay, especially given the fact they see things like bismuthinite. Remember, bismuth is a common metal in these systems. I don't know if they've seen tellurium or not, whatever. I can discuss that later, but it smells, it's got that wonderful odor of reduced intrusion to me. Very interesting. Now, go to the next. I think I have, hold on. I got to share screen again. I know I'm taking forever, guys. I will speed my butt up here.
No worries. So,
okay, Goliath. Here we go. Okay, you're seeing it, right?
Yep.
Okay, so we're looking straight down on our baklava here. It's the big blue thing. I'm going to turn the surface off because the bloody topography is slowing the computer down. Okay, but when I do that, you can see the lodes in their current form, and they've done an exceptional job of modeling these things. Okay, now the company is drilling some holes way out here. I don't know if it's these or what. I think it's way out of here at a place called Jackpot, where they had some very high grade surface samples last season, and so I think this system actually extends way the heck out here. We'll see. But what I want to talk about right now are the drill holes that have just recently come back. Last week, I couldn't show you on the video, where this gold is occurring. But you can see now we got 2 holes. We got one here, that guy. Didn't click it exactly, whatever. There it is. And then we have this guy. Okay, this one. And you can see the little yellow blobs. Now, these yellow blobs, that guy and that guy, are probably part of this ledge, which I think is the Bonanza ledge. Then we have another one here, Golden Gate, sorry. And I think maybe some of the gold in this intercept is part of this. But notice a lot of that yellow blob is actually well below the Bonanza ledge. Okay, so, or sorry, Golden Gate ledge. So there's clearly more going on now. This most recent hole, they've got boink, boink, boink. I might be getting my holes mixed up, but they got gold way the heck down here. Okay, so that's well below. There's more of the baklava. Okay, down there. So very interesting outcome. Looks, and the intrusion is roughly in this position. Okay, so now we know there's likely an intrusion here. This story is going to get very interesting very quickly. Okay, I like it. I like the way they're heading. We got to wait for assays, but they're on the right path. Okay, now last week I didn't get to show you the Sitka. Since we have very little time, go back to last week's video. This week I got the model working. Okay, so I'm not going to go through the whole spiel again. You got to go to last week's video. But what I'll do is I'll jump straight into share screen and give a little airtime to Sitka and their deposit. All right, and what they've been drilling here recently. Okay, so hopefully you can see this again. Okay, we got to look straight down on it. Okay, first of all, this is the project's called RC. All right, and this is the Blackjack deposit. And last year they started tagging some high grade that was deep and kind of towards the southern end of Blackjack deposit. Okay, now it's completely open to the south, and as we know, they've actually picked up all the land down here, and there's lots of big intrusions down here. I think they're on the fringe of something here, and I think as they work their way southward, they're going to connect in with the mothership. And don't forget, over here you got the other deposit. I can't think of the name of it. Name's not on there. Shoot, whatever. Anyway, they got another little deposit. I think it's just the smoke on the edge of something bigger. But I want to show you what the drilling they've done this year so far looks like in its context. Okay, so last week they had a news release talking about this hole, this guy right here with the yellow polka dots, that thing, and this one. All right, and you can see these are pretty decent step outs. 50, 60 meter step outs or infill from existing holes. I think we're going to see some nice grade. They saw lots of VG in these holes. Looks very, very valley-like. I would point out that there's nothing that says it's stopping here yet. Don't know why they stopped the holes, but whatever. To me, it looks like they're stepping into something. Okay, we're looking east now. I think they're stepping into something. I think there's going to be something really, really big down here. Imagine an entirely preserved valley-type deposit right here. Okay, you might say, well, gee, it's a couple hundred meters, Could you mine it? Yes, we can bulk underground mine very easily in this day and age. In fact, sometimes that's even more desirable because we don't leave big open pits. But this looks like a very interesting discovery that's taking shape. I think the company does have more aggressive drill plans later this season where they actually drill well to the south. Okay, like I think they're going to drill some holes down in here. And hopefully we see this Blackjack deposit just grow by leaps and bounds. I wouldn't be surprised if we start to see a lot of gold pop up down in this region. Okay, let's go back. I'm getting there. Next. Brixton announced first hole from Camp Creek. They are drilling at Camp Creek, mainly focus there, in fact, this year. They hit almost a kilometer, 960 meters. Think about that, of 0.39 percent copper equivalent. Okay, now because Gary and his team are really efficient, I do get the data from them, so I can put a 3D model together, and we'll look at that in just a second. Okay, go to the next slide. This is a big hole. It's in the Camp Creek target, which you can see as part of their Thorn project is towards the north end there. But this is a world-class, potentially world-class deposit. Go to the next slide. Here you can see in cross-sectional view, looking through the drill holes that have been drilled to date, you can see the position of this hole 290, okay, and where it fits in context. Now, I'm going to show a 3D model here in a minute. But right now, this drill array defines an area, roughly 500 meters in around, like in diameter, okay, in plan view, but it's also about 500 meters tall. Right now, I'm going to show a 3D model to give people a better sense of what we're looking at now. I told you a lot of 3D models this week. Come on, you! Don't you be stupid now. Okay, there we go. Just slow. All right. Here's an aerial view plan view of Camp Creek. Major drainage here. Then there's a little side drainage going up here. The porphyry system basically sits under this area. I'm going to turn the surface off for just a jiffy so we can see what's going on. Okay, as we tip the drill holes up here, you can see now from the colors a very cohesive, and look at the grades over here. Okay, so the reds and the pinks are, we'll call it 0.45 or better. There is a very cohesive high-grade core to this, guys. Yes, there are a few post-mineral dikes, so where there's dead stuff like this, it's simply a post-mineral dike that's intruded in here. Otherwise, we're seeing a very cohesive blob of high grade. Now, you might say, well, these look like they cut off. Not quite. Okay, so if I tilt this about like so, this porphyry seems to be plunging in this direction. Okay, that's my bet. And why do I say that? Because way up here, we have a breccia pipe that probably erupted from the porphyry at depth. I think there's still a lot of runway here. I think that this deposit could basically dip down like this, and this thing could be a multi-billion ton deposit. Right now, what is it? Maybe a 600 or 800 million ton blob is shaping up here, but I think it's wide open for growth. Okay, and I say that because I think the whole thing's been tilted slightly, and the breccia pipe, which would have vented vertically, is now way over here, which tells me the whole thing is tilted. Right, vertical would have been this way, or rotate this back, and that would reconstruct the original picture. All right, I think that's the last model. Go to the slide deck. I think I just have a couple slides left. So great progress there. Go to the next one. This is a breakdown of assays within that. There are some pretty high grade intervals. Moly is notably higher here, which is very unusual for porphyries in this region. Okay, typically the porphyries up in this country, like in talking down into the Golden Triangle and stuff, are more copper gold, not necessarily moly porphyries. Here we see actually very strong moly, as well as even significant silver. I'm not saying super high, but some silver. That to me says this is a different porphyry, and I think everybody who knows Camp Creek now knows this is a different age, a younger age. By the way, core assets, which is not that far from here, probably has a similar porphyry underlying them. Okay, probably something that could be multi-billion ton. This is a world-class porphyry that's shaping up. BHP is part of the story. We're part of the story. Nice to see them make progress. It's a tough year for mining, but good to see good results. Go to the next slide. This shows you some of the core, nice coarse chalcopyrite, as well as molybdenite down there in the lower right. This metallurgically, this should behave well. It should make a good concentrate. Next slide. And then these are simply logs showing the drill hole, but also the distribution of metal. It's really interesting to see because the copper and the moly are slightly offset. Okay, the moly was actually picking up at the end of the hole. There might be another porphyry down there somewhere. I don't know. But the copper, which is the red, a little bit higher in the hole, and then the gold, there is a significant amount of gold. Okay, it's not absent, is more coincident with the copper. All right, go to the next slide. Sorry, I'm plowing through this juggernaut. And now they're drilling at Bingo now. Okay, they had some very high grade results at Bingo last year. I went up to the property. We didn't spend that much time. It was hard to get a sense of scale, what this might be, but the results that came back, I felt were very impressive, and it's nice to see them follow up on these. Okay, so they are drilling at Bingo. Go to the next slide. This slide shows you where they're at. It's not that far from Sherbet. Okay, so this property in geologic context is actually not that far. It's a few kilometers, we'll call it. And it looks very similar, like the nature of the quartz veining, deep level, milky quartz, very coarse grained stuff. And the shear zones or the veins look very similar to Sherbet as well. Okay, so this is our target. It is wide open along strike. Hope to see good numbers come out of this. Let's go to the next slide. Nevada King had a very good hole this week. It comes out of a kind of a new area, an interesting area. The gold occurs in intrusive rocks. This is not the normal style of mineralization they see, which is in the sedimentary rocks. This is actually hosted by intrusive rocks, but it was in the headline there, they got 6.28 over 54.9 meters. That's within 68.6 meters of 5.14 grams per ton gold. Killer hole, 350 gram meter. Go to the next slide. What does this mean? Well, this is the CSM. Sorry. Okay. There's the image of where the hole is. It's actually at the south end of the Atlanta pit. It's in a very interesting area that defines the boundary between rocks to the south, which is that hill slope with the orange, as well, from the rocks underneath the pit to the left-hand side, which is north. Okay, let's look at CSMT sections that go across this thing. Let's go to the next slide. You'll see right away, boom, that high grade is right at the boundary between very resistive rocks on the left and less resistive rocks. Hold on, I might have things mixed up, but whatever. It's right on that gradient, very sharp gradient between the two rocks. What does it mean? It means there's a big structure there that was pumping gold up. And it also means that other big structures like this in this area could also host high-grade gold. This might be the secret sauce to finding high grade at Nevada King at Atlanta. Let's go to the next slide. Now, I say this because here in this image, there are other places where we can see breaks or gradients, like changes, rapid changes of resistivity from one place to another. This just opens up a whole smorgasbord of new targets. And this is the kind of break they need to get, some more tonnage or some more ideas to test in front of them. I think they're currently amending their plan of operations to include these drill sites. I would expect sometime later this year, they should have an approved plan of operations that allows them to test these ideas. Go to the next slide real quick. Okay, Puma has done some prospecting north of where they've been traditionally drilling to date. And they've now found a new gold zone. You can say that they call it the new line gold zone, up to 72 grams gold. I looked at the photos, looked at the news release, little bit light on data, but it looks like the same style quartz well to the north. It's just simply an indication that gold system is much, much bigger. I'll be anxious to see what these guys actually do this year in the field to follow up on this. Go to the next slide. I think we're getting close. Hopefully that should be it, right? I think so.
All right. Kevin, you got to unmute yourself. There you go.
All right. Hey, sorry about that. So if you have any interest, in looking at our strategies, I think the timing right now is incredible. What Quentin was telling you about what's going on in the Yukon, of course, it's a temporary setback, but look, we don't own any Victoria. Victoria is the one that's having the major setback, and yet this news has affected all of our other Yukon stories, and we have several others. We've got Snowline, we've got Sitka, we've got Rakla, and Onyx as well. So look, this is an opportunity. Especially, you saw the great news with the drill results at Snowline. But look, we also own some Cantex. Cantex did have some news that they have temporarily stopped drilling in the Yukon, and they still don't have their deal with the First Nations. That Victoria incident happened on the day they were about to sign their deal, and they had agreed on a deal, but the incident happened. It never got signed. They have to renegotiate it. That's why they've temporarily stopped drilling. But we think they're gonna get to their deal. But meanwhile, look at all these other opportunities that have pulled back, whether it's Snowline, whether it's Sitka, that are incredible stories. We've got Rakla and Onyx up in the Yukon too. Look, we've got 70 plus different mining investments all over the world that we're invested in, but we do have a handful in the Yukon, and some of them are pretty big positions like Snowline. This is an incredible opportunity to put money to work in this temporary setback, because it's not a permanent setback. There will be mining in Canada. There will be mining in the Yukon, and this is an opportunity to take advantage of this temporary setback. So yes, it is some negative news, but look at all the other positive news. Look at the drill results at Snowline. They are incredible, as Quentin just showed, and they have like 3 new target discoveries on the property as well. That I think the one at Jupiter he was talking about is already a bona fide discovery. and look at the aggressiveness that they're pursuing that. And then this other target, this other valley-like target that Quentin showed, the other intrusive target. There, I forget the name of it now, but this is time to be putting money. Go ahead, Quentin.
I said Sydney.
Sydney. There's a potential whole other valley discovery at Sydney. So what an opportunity to put money to work. The short positions in our global macro and long short funds are really starting to kick in. Those funds are doing really well month to date. And the opportunity for this great rotation that we talked about, there's opportunity on the long activist metals side of our portfolios, whether it's the precious metals fund, whether it's the long short of the global macro funds, where we have the long metals positions as well as other long positions in energy and biotech, and we have the short positions as well in those other funds, global macro, long short, that are just starting to work. This is only the beginning of this rollover in the Magnificent Seven, this great rotation that the media is talking about now. It's not just Crescat talking about the great rotation. We've been talking about it for a long time. Well, it's happening now. And the money will be rotating into value, into natural resources, industries, into small cap. This is what we have. This is what we have. And if you're interested in taking advantage of the timing now, I think the timing is fantastic. Give Merrick a call, and it's time to get invested. It's time to be putting money to work. We're going to have a new letter coming out. Tavi, you want to tell them about the letter?
Yeah, letter will be out hopefully tomorrow. I'll also put out a tweet, and it's going to be mostly about the things I presented here. I just want to relate one thing that I was thinking about that I learned as well over the years is I said this before, you can copy someone's thesis, but you will never be able to copy someone's conviction. And conviction at these times when something gets tested is where you really make your money, in my view. George Soros and Druckenmiller back in the 90s, famous trade was the British pound short. Everybody knows that they made, billions in that trade. However, there's another trade that they made a lot of money, even more than the British pound trade, which was the Japanese yen in, I think, 1996 or so. And that trade was very interesting because they put the trade on. The trade went against the direction that they were betting on. And guess what they did? They went all in. and that's, it's adding to your conviction. When you have the conviction to be able to do that, is something that, that's really what created the best profits of their own firm at that time. So I think it's a big lesson to be able to have that level of conviction and act on it is something that is very substantial over someone's professional career. So that would be, I think that perfectly aligns with what's happening with Snowline, but that's just my opinion. Anyways, well, letter will be out this weekend. If you're interested in reading some of those views, you probably get it in your email. Anyways, but if you're subscribe to our channel and what is that?
I don't know. Somebody sent me this just now. I think if I'm not mistaken, that's a gold squirrel. Oh my gosh! Oh my gosh! Wow. Maybe that's a sign of something to come. I don't know.
Well, you might be onto something, Quentin. Who knows? Anyways, all right, guys. If you enjoyed this video, please subscribe to this channel. That way you can get notified of our upcoming videos. We'll be back next week. If you want more about Crescat, please contact Merrick. He's the person that would love to share more about our funds. Thanks, everybody. We'll be back next week. Thank you.